I mean, I think anybody can take a look and see. If you're talking about the physical markets, they can create as much paper as they want to. So for gold to be here, under $1,900 an ounce, and silver to be under $30 an ounce, with all of the buying that's been happening, even the CFTC came out, and the physical market is not really going to move the spot markets that you see, because they will just continuously sell more and more contracts that do not have the ability to deliver the underlying silver. Having said that, because I know a lot of people go, oh no, but the reality is these, both silver and gold, are primary and secondary currency metals. And with the currency clearly dying, a rising gold price is an indication of a failing currency, so it must be suppressed until enough confidence is lost that central banks have to lop off zeros, goes to the exponential piece, lop off zeros, because they do it against gold and silver as well, but gold is the primary currency metal. And even at that, on average, they do that 3 times, because I guess people are so gullible that, okay, they say this is going to make a difference, and so they go along with it. It doesn't make a difference, and so they do it on average 3 times. I can't tell you how many times it's going to happen this time, if they can maintain the confidence. But it's not the physical market, it's the paper market, and then ultimately it's the central bankers that will move all of these markets, and you'll see both gold and silver near their fundamental value. But the paper markets are dying. There are a number of different factors that would have an influence on the premiums, but since we're already near premium lows inside of this cycle, I would anticipate that the premiums would expand, and expand pretty dramatically, particularly if the government made the choice to do an overt gold confiscation. They've been doing covert gold confiscation forever, right? But if they actually went overt, now you have the only kind of gold that you can actually legally hold and use through this trend cycle. I would imagine that not only in a reset, obviously spot is going to be more reflective of gold's fundamental value, but I would anticipate that the premiums that you would have to pay to get your hands on it, since it makes up less than 2% of the total gold market, would explode, maybe go back to the 89 highs, maybe even go much further than that. Because there's a finite amount of physical gold and physical silver. There's an unlimited amount of the contracts, but there's a finite amount when you get to the physical form. History tells us that going back to a degree on the gold standard is the most likely outcome, and then again they'll whittle it away. But I can tell you from history is that we will see that ratio get more and more narrow. Once we're dead in the hyperinflation, then you're going to see that grow a little bit more, simply because gold is the primary currency metal. I personally I have a lot of silver. I like it for my barterable portfolio. I don't really hold that so much for my wealth preservation portfolio. I hold it for my ability to barter. And that's what you're holding: physical gold, physical silver in your possession, and also the food, water, energy, security, community, and shelter. Because these are all the things that we need to maintain a reasonable standard of living. Because even in Brazil, even in Venezuela, where you might have 80 to 90%, globally on average, 80% of the population ends up in abject poverty. I mean, we're talking middle class people to abject poverty, but I didn't say 100%. So we want to be in that 10 10 or 20% that has the ability to maintain their standard of living at a reasonable level, and dare I say it, even expand your wealth base, because there's lots of opportunities in what lies ahead for those that are holding their purchasing power. So when you see a big spike in interest rates, and honestly, this is something that I've been questioning, are the central banks losing control? Because the interest rates will the market is bigger than the central bank's ability to buy the bonds, let's face it. Especially with all of these derivative products. They don't even have to buy the bonds. They just have to put out a couple of bucks and buy derivatives against interest rates or credit or what have you. So I think what we've been watching as witnessed by the Treasury VIX is the handing off of control of the bond market to the traders. And we recently went to a new level in there. So when you see a big spike in interest rates, it's because of the loss of confidence in the central bank's ability to control things. And that's already happening. I mean, we've been watching this question come up for a number of years now. So big spike in interest rates, which I'm paying attention to as well. Yeah, they're between a rock and a hard place. You know, if they raise interest rates, what's going to happen to the stock market, right? And the stock market is benefiting the few at the top, and it's also making like pension plans and different things look better than they really are. So, yeah, we're in a mess, and we're at the end. You know, you've got to understand that gold and silver cartel are working for the central banks and also for themselves because of all of that trading revenue. So once they need that to be released, that's how they get vanquished, because that's the way they reset a currency. It's not like you've got a bunch of different choices. Oh, well, we can do it against this or this or this or this. No, they have to do it against gold, which is all intrinsic value, because it's used across the entire global economy. So it has the broadest base of functionality, and it has the broadest base of buyer. So I'm not counting on Wall Street to tell me how much gold and silver is worth, because that's just a fool's game, and I used to be a stockbroker. I get it. So I do my own calculations when I need to know.